So we're talking about how rising market prices affect smaller accounts. Smaller accounts, I usually suggest if people ask me, like, what should I do? I have $2,000, $3,000, $5,000, whatever the...
Get your uncle up.
Yeah. Do you have a rich uncle that you can call? But I think generally leaning long is the easiest way to start. Sell some put spreads. Mm-hmm. You know, if you have a couple $100 or a couple $1,000, you do, 60-40 or 70-30 in terms of long versus short positions. You pick a couple stocks that you're bearish on, sell some call spread, take a couple that you're bullish, sell some put spreads, do maybe one or two iron condors, and that's kind of your basket. But how do rising market prices affect smaller sized accounts? Despite all the noise in the market forecasting the overall market and individual stocks continue to climb higher. This won't last forever, not every single day.
At least take one breather.
With markets trading at all-time highs again, it may be easy to overlook the scope of the stock market growth. In fact, over the past 5 years, the S&P 500 has almost doubled, and the NASDAQ has more than doubled, and the Russell has increased by 900 points. Big moves to the upside.
Extremely large moves to the upside.
Yes. As asset prices rise, even for non-growth stocks like McDonald's, new traders can become more capital constrained since option margin requirements increase with asset prices. You also, your spreads become tighter relative to the stock price as well. Unless the stock splits to lower its price, traders must find underlying strategies that keep capital requirements low while maintaining high probabilities of pop. Here's just a list of like how much things have gone up. When you look back at just a handful of years ago, pre-COVID, you had Netflix at $400. Seems cheap. Meta, $284. The Q's at $284.
Yeah, unbelievable moves we've had in the market.
Yeah.
I know
some context for you. So simply adding long wings isn't always a solution. While defined risk trades are still available, a fixed width spread or an iron condor on an underlying that has risen sharply in price will see a significant drop in pop. So if you're looking at a $10 wide spread in a $500 stock versus a $100 stock, it's a way different probability, and that's because of the relative width of those spreads. $10 wide on a $500 stock is a relatively tight spread. On a $100 stock, it's kind of getting into a medium-sized spread. So to achieve the same pop, your 20 delta IWM iron condor would now need wings of $25 wide, making it far less practical for smaller accounts, especially when you're adding in skew. So it's just really talking about, and this is when you have to kind of take back testing as well with a grain of salt, because things change significantly. When you're talking about iron condors, profit and loss 10 years ago,
yes,
it's a dollar versus now it's $10.
Sure, and it was a lot more of a reliable trade when the market wasn't moving much because the strategy fits that. Now you weren't getting paid as much as you just outlined, but it had a great win ratio. Now you might be getting paid more, and iron condors aren't the greatest strategy on a longer term basis because we've had such exponential moves, which we just showed a moment ago in one direction. The
width has to adjust. You have to, as things get bigger, you have to have more risk.
Yes.
To compare apples to apples.
Agreed.
So to answer this dilemma is actually not as complex as it seems due to the beauty of product indifference. In other words, as long as the product you find is liquid, meaning it has like tight bid-ask spreads, the name of the company doesn't matter too much when it comes to risk-reward. I talk about this in our whiteboard series of, looking for implied volatility. Liquidity is another huge factor of this. But when you have two products that have 50% implied volatility, it doesn't matter if it's AMD and Micron or Apple and Microsoft. The same amount of risk premium is priced into those products.
Yes.
The difference in the premium is relative to whatever the stock price is. So if you have two stocks and they have the same implied volatility and the same stock price, it doesn't matter your personal opinion on which one is more risky. They're priced the exact same from a risk perspective. And so we take when we say product indifference, that's really what we mean, is that there's just, it's all about volatility, time. Those are the things that we trade around. So assets below have a relatively high IV and high IV rank, are liquid, and are reasonably priced, so iron condors or even strangles may be doable for traders with small accounts. So these products, are ways to get smaller versus something that's a little bit bigger. Maybe looking at some of these products here.
Yep.
Next slide here. So smaller accounts are often too capital constrained for undefined risk trades, which is why many Tasty Bites traders prefer defined risk setups. But how can we strategically use undefined risk trades so they remain accessible for smaller accounts while keeping their key advantages? What do you think? They spoiled it for you. If you can.
What's that?
They spoiled it for you.
They did spoil it for me. I'm just looking at volatility in the market right now, up 51 cents. Big move, almost 3% on a relatively small move on the market, down 7 here. Maybe you do have a little bit of a crack here in the market. Bonds are still up 21, 119.14, making new highs. Giving a little bit of a flight to quality at I don't know if it's flight to quality.
I think it's just the move in gold.
It could be, yeah.
That's
Gold down
109. Like.
Gold down 167 right now. Sorry, down almost 4%. Silver down almost 6%. I mean, that's those are big numbers.
Yeah,
but they've been big numbers to the upside too. So like a 10% move in gold from
bringing it back down to middle of last week.
Yeah,
I mean it's been going 3% up.
Yeah.
So
Yeah.
I think it's just a little. It's a little liquidity spook that we're getting in the markets.
Maybe the market not as weak as you would think with volatility as strong as it is. So you got to place your bets.
The Russell, they're coming out of they're like, I need to hold this
Russell
NASDAQ up because you're not.
Right.
With bonds rallying, you would expect small caps to be relatively strong, and they are by far
the opposite.
It's a complete weakness, and that's
it's a struggle between good and evil right now.
Yes. Who wins?
Bitcoin down 2,200 to 118 and change.
Oh, it hurts.
October, my butt. Talk to him when he gets in here.
He's got the day off today. He's on tomorrow.
Oh, good.
Next slide here.
For me.
So for both low and high IV underlyings, using a defined risk strategy will cost some credit compared to an undefined risk strategy. So here are a couple stocks that you can look at in terms of low IV and high IV and what you get paid. These are the same price. I think this is exactly what we're talking about when we just riffed about volatility and price. When you're looking at something that is the same price but has low versus high volatility, you could see how much more you're getting paid to take that risk, and why it always comes down to implied volatility, and why we're always looking for high volatility is if you took the ticker, and these have, in my opinion, different risks.
Yeah.
But
that's what you're supposed to have on the show, opinions. So
yes,
good job out of you.
Yes. So the next slide here, when using undefined risk trades in low IV stocks, you get a sizable increase in buying power. However, in high IV stocks, the percentage increase in buying power is much less. This is telling you about how risk is priced. So like you're getting paid to take risk in INQ, and because of that, the where the risk is way further out of the money. In Delta, you would expect, because it's low IV and it's less risky, that you wouldn't have to put as much capital up, and it's inverse. So the higher volatility stuff, because you're much further out of the money, and the actual risk in terms of volatility is priced higher, you don't have to put up as much.
That's right.
Buying power decreases.
Yep. It's a complete math model here, really, is what you're looking at. I mean, it's really what it is.
Yes. For you to lose the $600 on INQ, you need the stock to move a lot more than Delta.
That's correct.
And by Delta, I mean Delta Airlines.
Yep.
The stock that we're looking at.
Right. It was an odd one to use, Delta.
Yes.
As Delta Airlines, yes.
So a couple takeaways here. So many popular assets have more than doubled in price over the last 5 years, increasing the difficulty for new traders. Defined risk strategies come with a cost of some credit, of course, because you have to buy those wings. You're essentially buying your stop loss. Undefined risk and high IV stocks offer a better credit to buying power ratio, and our smaller buying power increases, making undefined risk more feasible. That said, things can change. You get big moves in an INQ or an OCLO, and requirement certainly can and likely will increase if that volatility is realized. New traders should focus on product indifference, prioritizing high liquidity, moderate to high IV, high pop, and low capital requirements over specific asset names. Not about that. You're not really trading Apple stock.
No, you're not.
You're trading Apple volatility. You're trading Apple time. You're trading Apple risk. Those are the things to keep in mind.